So welcome to tonight's class, which is class 7 of 8. We will have on Thursday we'll have class 8 and that will be done for the 8 classes. Next week, Tuesday, Wednesday, Thursday, we will do the revision class. So today I shared with you some question papers. There's no need to do all of them because like some of the videos that I've shared with you, I went through those most of them, so you can watch some of the videos if you have time. If you can get through all, that will be great, but ideally make sure you focus on the big topics and you're able to answer the various topics. Okay, make sure that you can sit back without having a paper in front of you, without having any notes in front of you, and just basically think. If you must go through WAC, you need to be able to tell yourself what are the key issues of WAC, how do you perform a WAC calculation, what are the various methods, and so forth. So you want to be able to do this while you're drinking coffee or anything, but like you're not sitting in front of a question. You want to be able to walk yourself through it. It might not be easy initially, but as you practice, you will be able to get there. So I shared 4 papers, and then I'm gonna share with you the question bank. Now, don't go to all the questions in the question bank time. Why I'm gonna share it with you is because the working capital questions that you must work through is in there. I'll tell you which questions. Okay, so just remember that. So don't now do all 30, or I think there's like 40 questions in the question bank. You're not going to get through all of that. So what you want to do, you want to set up your timetable with the key topics as I shared with you, and then have your 3 to 5 questions. And then you want to identify which 3 to 5 questions you want to cover. So let's say you're going to do 3 questions per topic or per major topic, then do it on a topic basis. The first 2 questions, do it on a topic basis, but then question 3 needs to be on a full exam paper. Okay, so when you're learning the topic, you do questions per topic. But once you are revising, you need to write a full question paper, okay, not topic based. So, so just make sure you plan properly according to that. So just make sure, and if you have any questions, you can ask me. Remember, if you must do more than 5 questions on a particular topic, question 6, question 7, question 8 is not going to help. There's obviously fundamentally something not right. Then rather contact me so we can discover what the issue is. So just remember that if you're still struggling after 5, then it's not, more questions is not going to help you. So try to work through, and then if you have specific problems, let me know so we can. Like I said, I'll have 20 to 30 minute one-to-one sessions. So why 20 to 30 minutes? Because we don't want to go through an entire question paper. All we want to do is then focus on one issue and resolve that one issue, and then you can come back if you have another what you call it. So I'm not going to go through an entire question with you in the session. There might just be 1, 2, or 3 big issues that you want to be resolved in a 20 to 30 minutes. If I find more than one person or there's a few people that is having the same issue, then I'll create a group session. But remember, it's all going to depend on you for you to work through those question papers. Okay. So this week will be the last 2 lessons, and we're going to cover capital budgeting and valuations. Now remember, WAC, capital budgeting, valuations, WAC, capital budgeting, valuations, and then kind of financial analysis. Those are generally the big topics. Okay, it does not mean that those will always come in, but 2 to 3 of that is definitely going to come in. Then you have the other topics that I won't say it's not big, but I call it the medium, the orange range, right? Where they are medium, meaning that they don't always get tested, but when it do get tested, it's a big question. So that could be, for example, working capital, source of finance, And nowadays I see they're very big on strategy and risk management. The reason why they're quite big, I'm assuming why they're quite big on strategy and risk management, because on a CTA level, that is quite big because it's a big topic for cycle. Okay, so cycle wants CAs to have be broad in their studies and not just be technical experts, but must be able to identify risk and provide insights when it comes to strategy and risk management. So if strategy and risk management come in, it will be quite big. It tends to come in. So how it tends to come in? You must do a SWOT analysis, or you must do a PESTEL, or you must identify risks and provide mitigating responses. Okay, so just be aware of that. So in the question bank, there's a question or two on that, so you can just have a look. Like for those type of questions, you don't have to write it out. All you can do is read through the scenario, try to answer it in your head, and then look at the solution, and then try to build a framework for thinking from that. Okay, but if you want to write it out, you can write it out. So we see source of finance, strategy, risk management, and governance, and working capital. Those are like for me, that is like orange. So if it does come in, it is quite big. Okay, like I said, perhaps strategy, risk management will go into the green section, meaning it get tested often. Okay, but what you must know, capital budgeting and valuations and WACC. Those are like the big topics within corporate finance, financial management. So those three topics and so are very big topics within financial management. Okay, so just be aware of that. Then like the smaller topics, like you don't just bother with it. It's gonna be like dividends. What else did I say? Ethics. Okay, ethics is big nowadays because of all the scandals that went around. But dividends and so forth is quite small. Don't bother. Okay, so you rather focus on the big topics, score your marks over there. Dividends will be like 5 marks. So if you have time, then you can, but otherwise, I don't bother with dividends. On a CTA level, you must know your dividends. Undergrad, not so much. Okay. So now I'm going to go over into capital budgeting. I'm going to use a question from the question bank. Just so you know, the question bank are basically past exam papers. All that UNISA did was they took probably the best of the exam papers per topic and they put it into a question bank. Okay, so doing a question bank is doing past papers, just so you know. So also for working capital, I'll share the question bank now. For working capital, question 14 and question 30 from the question bank. Those two is important together with what we did in that assignment too. Okay, so those are the big types of working capital questions that they generally ask. So question 14 and question 30. Question 30 is the credit policies issue scenario, and then question 14 is a situation where you have the current working capital and then they tell you next year sales is going to grow by 80%. So what must your working capital requirement be to meet that sales expectation? So that is another type of working capital question. Okay, so those two you must try to work through. I know some of you are writing quite a bit, so you obviously have to manage yourself. But if you're only writing MAC, then dedicate at least 60 minutes a day. Ideally 90 minutes. But 60 minutes is okay to dedicate so that you can get through quite a bit of questions. Okay, so you can get through quite a bit of questions. That's definitely going to help you. And remember, you want to get through as many questions as possible, but the idea here is not to run through 1,000 questions and at the end of the day you can't answer the question, what did you learn? You must be able to answer that question, what did I learn? Okay, so make sure you can get through as many, but don't forgo the quality. Okay, so now I'm going to let me just quickly share the question bank. Okay, so I shared it. Just tell me once you receive. So we're going to do, which one did I say we're going to do? Question. So we're going to do question 8. Okay, so go to question 8. I don't know what page 15. Okay, so question 8, page 15. Okay, you should have it open. So, sure. Okay, so we're going to do this question on capital budgeting. So before we go into this, let me give you quickly a high-level overview of capital budgeting. So you want to understand what is capital budgeting and why is capital budgeting so important. So basically, when you have to make a decision regarding a long-term investment, then, or a long-term project, then you're going to fall into the domain of capital budgeting. So capital budgeting is all about helping you make a decision regarding a long-term investment. What is the decision? Whether you should go ahead within the investment or not. So what is a long-term investment or a long-term project? So an investment and project is just basically an asset that will generate cash flows over a period of more than 1 year, of more than 12 months. So if an investment, if a project is going to generate cash inflows over a period of more than 12 months, then it's considered to be a long-term investment, a long-term project. So if you have to make a decision, that is whether to invest or not in a project of that nature, then you fall into the domain of capital budgeting. So typical examples would be Eskom building a power plant over the next 20 years, Cecil building whatever kind of plant they build over like 10, 15, 20 years. So you can see cash flows, it takes long to build those projects, and it takes long before they start generating some money. So that is why before they, and the cost of it is significant. So before they're going to go ahead and just constructing, they're going to perform an analysis to determine whether it will generate them money in future or not. So the question is, why is capital budgeting so important? So what you must understand, every single business wants to operate long term. No business, or most business, like probably 99% of people that starts businesses, they don't just want to run a business for the next 12 months. They want to start a business and it operate like forever and ever. And in order to operate forever and ever, they, at a minimum, they will have to maintain the business, maintain the operations. Think about an Uber driver. If he wants to be an Uber driver forever and ever, then he's going to have to replace his vehicle after 5 years. So he needs to make sure that he has enough cash flow in order to replace his vehicle in 5 years' time. Similarly, if you really want to live long, have a business that runs long term, you can't just maintain your business, you have to grow it. So as a result, in order to run a business sustainably over the long term, you have to continuously make investments in long-term projects in long-term assets. Okay, and that is why capital budgeting is such an important concept, because of the fact that you're going to have to continuously reinvest. Okay, so that is the what and that is the why of capital budgeting. Remember, capital budgeting is an investment decision. WACC is a financing decision. So, well, not really a financing decision, but it helps you with decision making. So WACC, source of finance, capital budgeting, valuations, those are like the big topics underpinning financial management. Okay, so that is the what and the why. So the question is, how do we go about, how do we make decisions? What are the, so we use capital budgeting techniques. So how do we make the decision? Through capital budgeting techniques. So the question that comes is, what are the capital budgeting techniques? So there are basically 4 or 5 capital budgeting techniques, of which one is the main focus. So you have the techniques are, number 1, in no particular order, but number 1, NPV, net present value. Number 2, IRR, internal rate of return. Number 3, payback period. Number 4, discounted payback period. And number 5, the modified internal rate of return, known as MIRR. Now, the modified internal rate of return, we don't have to bother in undergrad. In a CTA level, you might just know about it. You don't have to be able to calculate. We're not required to be able to use the technique. We might just know about it. So in undergrad, you don't have to bother. So basically, we come down to 4: NPV, IRR, payback, and discounted payback. Now, payback and discounted payback is basically the same thing. The only difference between the two is that the discounted payback period takes discounting into account. So so of the 4, there's only 2 that are superior. Okay, so all of them are cash flow basis, based on cash flows, but only 2 of them are superior. So the 2 that are not superior is the payback and discounted payback method, and you shouldn't be using those methods as your main decision-making technique. Rather, you can use it as a reasonability check. Okay, so why shouldn't we do payback? The payback period only takes into account cash flows up until the point that you make back that you recover your initial investment. So if, let's say, your investment is R1 million, it's only going to take into account cash flows up until the year that you recover your initial investment of R1 million. It does not take all cash flows into account relating to the investment. So that is the one problem. The second problem is with the payback period, it does not take discounting into account. But that is what the discounted payback period fixes. The discounted payback period takes discounting into account, but still it has the problem that it only factors into account cash flows up until the point that you recover your initial investment. So that's the problem, and you don't use that method unless they specifically ask you for it. Okay, so what are the 2 superior? It is the NPV and the IRR. In most cases, the NPV and the IRR will give you the same result. Not saying the answer, but the same result. What do we mean by result? That both will tell you to accept or both will tell you to reject. However, there are certain instances when it gives you conflicting results, meaning the one would say accept and the other one would say reject. So in those limited circumstances, which one do you choose? You always make use of the NPV. And the reason for that is the NPV is a rand value. It is, or not rand, but whatever, it's a value, whereas the IRR is a percentage. So if NPV is more than 0, it means it's making money. And that is why, because you can exactly see how much money you will be making, the NPV is considered to be more superior as opposed to IRR, which gives you only a percentage. Okay, so just be aware of that. So our focus is going to be NPV. However, in one of the exams, they asked you for I or R. What you must know that in order, the way we do it, when I say we in MAC3702 in CTA, when you need to work out I or R, you still have to do the NPV calculation. So if you can do NPV, you can do I or R. Once you get NPV, you will simply press one button and it will give you the I or R. Okay, so I'm going to focus on NPV. But in the exam, I mean, one of the 2020 papers, they ask you for I or R. But like I said, in order to get I or R, you must do NPV. And then once you get NPV on your financial calculator, you will simply press one button and it will give you, or actually two buttons, and it will give you I or R. Okay, so just take note of that. So what's our focus going to be? We're going to do NPV. So remember, NPV is the most superior form because it actually gives you the cash flows in a rand value for a South African company. Okay, in another company, whatever currency, dollars, whatever. Okay, so just take note of that. So remember, what's the decision making? For NPV, if NPV is more than 0, meaning if NPV is positive, you accept. If NPV is less than 0, meaning if it is negative, you reject. For I or R, if I or R is greater than WACC, you accept. If I or R is less than WACC, you reject. So why does this make sense? Remember, what does WACC represent? WACC represents the cost of finance. So if the return on the investment is more than the cost of finance, the company will be making money. However, if the IRR, if the return on investment is a very loose term. I'm just using that to bring it closer to our minds. So if the return on investment IRR is less than the cost of finance, then we're actually losing money. Because why? The cost of finance is more than the money we're actually generating on the investment. So that means in order to cover the cost of finance, we're going to have to find cash flows from another project within the business. So that is why that destroys the value. Okay, so just be aware of that. Okay, so that's the quick high-level summary. You can watch the other videos on capital budgeting, where maybe I give the same explanation, but a little bit more longer, I think. Okay, so while I'm gonna, before I start this question, is there any questions you may have before we actually tackle this? Dane, Ungani, Nunku, Talita, is it clear? Any questions before we go on to the scenario?
I'm all good.
No.
Okay.
Not doing on my side.
What do you say? Oh, you're good. Okay. Okay, so let's get going. So, so they say Mashesha is a transport and logistics company which operates a national distribution network with a large client base and utilizes a rigid dispatch and prioritization schedule. Mashesha is currently in talks with Moya Technology, a company that distributes prepaid airtime to wholesalers, retailers, petrol stations, and end users throughout South Africa. Moya's business model is such that it customizes the delivery of prepaid airtime according to the circumstances and requirements of its clients, some of which are highlighted below. So Moya supplies a large number of retail chain stores with prepaid airtime by sending them a file via email or electronic file transfer. The file contains pins which retailers then split and send to their various outlets. Prepaid airtime is supplied to smaller businesses such as corner cafes by installing mobile point of sale terminals. This allows for encrypted pin inventory of frequently used products to be delivered and stored on the POS. The devices are operated by the cashier and are password protected, ensuring transactions are secure. For the less structured operations, mobile solutions are provided. Vending machines are supplied to busy supermarkets, 24-hour forecourts, and hotels. These are standalone units which can be operated by the customer. Okay, so you just take note of that. So there's the different types of the way they deliver the airtime. So say Moya had previously undertaken the delivery of prepaid airtime in-house. Moya has recently been experiencing several staffing problems, and given the nature of its large geographically dispersed customer base, Moya has been finding it difficult to keep up and has made many late deliveries over the past few months. Moya's customers are extremely unhappy and have been inundating them with complaints. Moya has decided to outsource its distribution operations to Mashesha in order to focus on its primary business. For the delivery of prepaid airtime to its customers, Moya has proposed to pay Mashesha a fixed monthly fee of 450,000 Rand and an additional 75 Rand per 100 kilometers traveled, all amounts at today's value. Okay, so this is very important to take note. I'll explain this as we do the question. In return, Mashesha will have to pay a once-off cancellation fee of 100,000 Rand in the event that Mashesha terminates the contract before the expiration of its 5-year period. Okay, so Mashesha will have to pay a once-off cancellation fee in the event that they terminate the contract before its expiration of 5 years. So remember, we only factor this in if we cancel. Okay, so and you can see it's a 5-year period. When it comes to capital budgeting, there are two things that you must try to identify early on. What is year 0? What's your reference point? Your reference point is year 0, and then also the length of the capital budgeting period. So here it is 5 years. Okay, so let's have a look. So let's say in order to undertake the delivery service, Mashesha will have to purchase a fleet of delivery trucks, an upfront capital investment of 4.8 million. Okay, these trucks are reliable and fuel efficient, requiring 7 liters of fuel per 100 kilometers for the first 3 years, whilst 9 liters of fuel are required per 100 kilometers from year 4 and year 5. In accordance with the delivery fleet maintenance plan, annual maintenance costs expected to be 336 in year 1 will escalate with increasing multiples of 2% every year as the delivery fleet increases with age and usage. For accounting purposes, Mashesha depreciates its truck over the useful life determined to be 4 years. SARS allows a wear and tear of 20% per annum on a straight line method. The trucks will have a combined resale value of 1.2 million at the end of 5 years. Total monthly salaries of the truck drivers are expected to be 264 in the first year, with a 7% annual increase thereafter. Other costs relating to the delivery fleet is expected to amount to 65,000 per year in year 1. Okay, so they're giving us a tax rate. They're saying the fees paid by Moya to Mashesha and other costs relating to the delivery fleet are subject to an annual escalation of 5.9%. The weighted average cost of capital is 15%. The current price of diesel is 11.41. An average annual increase per liter are expected to be as follows. Okay, so there's the increase in liters. They say based on the current information and taking into account Moya's growth plans, the following represents the kilometers expected. Okay, so this is giving us the kilometers. Okay. So here they're saying, so here they're saying, based on the principles of capital budgeting, advise Ms. Shesha whether it will be beneficial to accept the terms of a contract proposed by Moya. Okay, so whenever you have to make a decision regarding a long-term project or a long-term investment, then you will have to use capital budgeting. They will generally tell you which method to make use of. They're not telling us, so you just always assume. If they don't tell you which method, you always assume to use NPV. Okay, so that is what I'm going to do now. I'm going to give you a basic overview of how to set up NPV, and then we will go through the specific question. Okay. So when it comes to capital budgeting, we're going to set up like a cash flow table. Okay. So your first column will be, I call it details. The second column would be year zero. Okay. So you're always going to have year zero. We will always have to know what year, when is year zero. So year zero is now. Okay. So just that's very important. And then you will just, the next columns will be the length of the project. So in this case, the length of the project is 5 years. Okay. Now there are 5 principles when it comes to capital budgeting. Okay. So capital budgeting in general, not just NPV, capital budgeting. So there are 5 principles in no particular order, but basically number 1, we're only interested in future differential cash flows, future relevant cash flows. So very important, we only want cash flows. We only want cash flows that must still take place, future. So any cash flow that have already taken place, that is a past cash flow. It is not a future cash flow. So a past cash flow, a cash flow that have already taken place, is known as a sunk cost. So it's very important. You only want future cash flows. So any item that is non-cash flow, like depreciation, we don't include. But I also made mention of a term called relevant or differential. Differential, relevant is the same thing. So what makes something relevant? What makes something differential? If a cost or an income, if a cash flow will happen, irrespective whether you go ahead with the decision or not, then it's considered to be irrelevant. It is considered to be non-differential. However, if a cash flow is only occurring as a result of the decision, that makes it relevant because as a direct result of going ahead with the decision, you are going to incur or make this money. That makes it a relevant cash flow. Okay, so that's very important. So for example, over here, if we go ahead with the investment, if we go ahead with this contract, we will incur the cost of the new vehicles, the whatever 4.8 million, whatever it was. So that makes it relevant. If we do not go ahead, we're not going to incur the cost of the 4.8 million. So that means it is, that is why, in this case, that is a relevant cash flow. It's only as a result of the decision that we're going to incur, the cash flow is going to take place. Okay? So that's very important to take note. So that's the first principle, future differential cash flows. Number 2, it must always be after tax. So at the end, we're gonna have to do a tax calculation because we'll be interested in after tax cash flows. Number 3, the timing of cash flows is important. It's very important to understand in which column to put the cash flow in. They're going to test this thoroughly. Okay, so you must always take note. If you put it in the wrong cash flow, if you put the cash flow in the wrong column, you're going to get it wrong. If you put the cash flow in the wrong column too often, they're going to penalize you by subtracting marks. Okay, so if you do it once, it's fine. You can just lose that mark. But if they see you're doing it more than once, then they're going to penalize you for it because it's a fundamental principle relating to capital budgeting. So the timing of cash flows is important. So what you must understand, year one represents the beginning. Year one represents the end of year one. Year two represents the end of year two, meaning the cash flows is taking place at the end of year two, the end of year one, the end of year three. Very important. So each column represents the end cash flows taking place at the end of this period. So if they tell you a cash flow happens at the beginning of year three, you can't put it into year three because year three represents the end of year three. So a cash flow that happens at the beginning of year three won't go into year three, but rather year two, because the end of year two is the same as the beginning of year three. Okay, they're going to test you thoroughly on this. So like, for example, they're telling us we're going to have to incur the fleet immediately, meaning without having the trucks, we can't operate. So therefore, in order to operate year one, year two, and year three, we're going to need the trucks at the beginning of year one. So the beginning of year one can't go into the column year one because the column year one represents cash flows at the end of year one. So where do we put it? We put it into year zero. Okay, so just take note of that. So number one, I said future differential cash flows. Number two, we want cash flows that is after tax. Number three, the timing of cash flows is important. Number four, we must always take into account opportunity costs. So here's an opportunity cost over here, but in another question, there can be an opportunity cost. An opportunity cost would be the next best alternative foregone. So for example, a person have a car, right? A vehicle. Now he decides whether they want to sell the vehicle or whether they want to drive Uber. So let's say he decides to drive Uber. So the opportunity cost, the next best alternative foregone was the fact that he could have sold the vehicle. So that's an opportunity cost. There was two decisions. He chose one. So therefore he's foregoing the other. So you must bring that into your calculation. Okay. And then number five, you must not mix financing with investment decisions. So for example, if they gave you interest costs, you won't bring interest costs in because interest cost is a financing decision, or it relates to a financing decision. This here is an investment decision, so we don't bring financing costs into account. The other reason also is that if you bring financing interest expense, which relates to financing, you bring it in, you'll be double counting because we take financing into account through the discount rate, the weighted average cost of capital. Okay, but I'll explain that again when I get there. So that's the general principles. Okay, so those are the 5 principles you must keep in mind. So if you get stuck and you're not sure whether to include an item or not, run through the 5 principles. If it meets any one of the 5, then you will take it into account. Okay. So, the typical item that you will include. So I'm going to include typical a general way, and then I will do it specific to this question. Okay, so I'm just going to give you a general template, and then we'll do one specific to this question. So the general template is very general. In the exam, you will use specific names. Okay. So the first thing you'll probably want to put down is the cost of investment. In most cases, not all the time, but in most cases, the cost of investment happens immediately. So we will put it into year 1. Because it is an outflow, it will be negative. Okay, so a negative, in this case, represents brackets. Then you incur the cost of investment, then you would have sales, you will have variable cost, you will have fixed costs, okay, and then we will have, I usually put it separate because I generally show it separate. It doesn't always come separate, but because I generally show it separate, that is maintenance costs, okay, because I generally refer to maintenance separately, okay. Now, these are all items. So you make money from year one. So we will have an inflow, 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 inflow. So sales, you're making money. So therefore it is positive. All of these costs, it's an outflow. So it will be negative. Okay, so you can see year one comes into year one, year, and so on. Because we don't make money immediately. We only make money throughout the year. So what we do, we assume everything happens at the end of the year. So therefore it goes into its respective columns. Okay, then you will typically have something known as a realizable value. A realizable value. Another term they will use is scrap value. So this is the amount that you will get. This is the amount you will get for selling the asset at the end of the investment period. So for example, at the end of 5 years, we will sell the vehicles. I think I did that. So it will come over here. That's known as the realizable value or the scrap value. So we're making money, so therefore it is positive. Then we could have an opportunity cost. There's no opportunity cost in this question, but there could be an opportunity cost. Generally, an opportunity cost would go into year 0 because you could have sold the Uber car now, but you decided not to because you want to drive Uber. So you have foregone the sale now. So it is a loss of income. Therefore, it is in year 0, and it is in a bracket because it is something foregone. Then lastly, we would have working capital. There won't be working capital over here, but there could be working capital. So generally working capital, there will be an outflow in year 0. So you must pay careful attention when they tell you working capital takes place. If they are silent, then it happens in year 0. But sometimes they will tell you it happens in year 1. So the outflow then will happen in year 1. If they don't tell you, it is in year 0. What they're never going to tell you is that you must always recover it back at the end of the period. So in this case, our period is 5 years. So we will recover the working capital. We'll make it back at the end of the 5 years. So we'll generally tell you when the outflow happens, but they're not going to tell you that you must recover it. You must know you have to recover it at the end of the period. Okay, then there can be any other stuff. Okay, but these are the typical items. So that's why I leave a gap to represent that it could be anything. Okay, anything else. And then, but lastly, we will end up with tax. Tax, we will do a separate tax calculation. And it will be over here, generally an outflow, you must pay tax. It could be positive as well, but it's generally an outflow. So it will happen over there. Okay, this will give us our net cash flows. And then, but we don't want these future cash flows. We want one value today. So to get future cash flows to a value today, we're going to have to discount future cash flows to its present value. Okay, so we're going to have to discount. So we need a discount rate. The discount rate for capital budgeting, the discount rate for NPV is always WACC. Pay careful attention. The discount rate for NPV is always WACC. Once you have the discount rate, that will give us our NPV. Okay, so this will give us our NPV. So we will get future cash flows, but we don't want future cash flows. We want a value today. So to get a value today, we discount future cash flows using an appropriate discount rate. The appropriate discount rate for an NPV capital budgeting question is WACC. Okay, so very important to take note. So once we have the answer, if NPV is greater than 0, then accept. So greater than 0 means positive. Okay. If NPV is less than 0, meaning negative, then we reject. Okay, so So that's basically how we go about doing this. Okay, so now we can use this to actually answer the particular question. Okay, so let's just have a look. What did I just want to do over here now? Oh, so now let's do the actual question. Okay, so I'm just going to copy this out over here. A few seconds. Okay. So cost of the investment that we have. Okay, so let's take this away. So now, where is this now? Okay, so you should be able to see question. Okay, so let's have a look. Where is this now? Okay, so it's the question. So basically the relevant information is starting from here. Okay, so the relevant information is starting from here. In an exam, you go according to the information. Don't go according to the template. Don't go according to the template. Because if you go according to the template, then you're going to jump between the scenario. Rather go according to the scenario. So just take note. So for example, they first giving us sales. Usually they give you cost of investment first, but they're first giving us sales. So we rather plug in sales. We don't go look for that because then you're going to jump between the scenario that's going to make it very inefficient. Okay. So here we read the scenario. So they're saying the delivery of airtime to its customers propose a fixed monthly fee. So a fixed monthly fee of 450 and an additional 75 per 100 kilometers. Okay, so 75 Rand per 100 kilometers. So let's have a look. Okay, so here we're going to have sales. So we're going to say, but now you must be more specific. So we're going to say sales, fixed fee, okay, sales, variable fee. I'm just calling it like that. You can use the exact terminology, fixed monthly fee, and you can say whatever revenue per kilometer, whatever you want to call it. Okay, they're not too worried about the terminology. All they need to make sense. It's easy for them to understand what you're referring to. Okay, so we know that it's 75 Rand per 100 kilometers and it's 450 per month. We know there are increase rates. So here they're telling us the fees paid to Moya and other costs relating to the delivery fleet are subject to an annual escalation of 5.9%. Okay, so that's important to take note. So it is 5.9%. That's the other costs. Okay, so we must know there must be an increase. So let's do the monthly fee. So I'll have my workings over here. Because this question will be a bit long, okay, I'm going to do my workings over here. Make sure your workings is below your answer. Okay, when I say below, meaning when the examiner opens up to the answer, it must actually be the answer and not workings. Okay, so don't start off with workings. Let the workings be below your answer. So I usually suggest my students to start the workings on a separate page. Okay, so here's my workings. Okay, so workings, here we're going to go working one. So working one, details. So yeah, because it's an increase every month now, we're going to have to so not always like this. I just said it happens to have an increase every month. Okay, so just take note. Alternatively, you don't have to do it. Actually, let me just change this. So here we're going to have monthly fee, and so here we're going to have monthly fee, which is, what was it now? Just make sure I'm using the right numbers. 450, 1, 2, 3. We're going to say number of months per year, which is a number of months per year, which is 12. So there we're going to say annual fixed fee. Okay. So the annual fixed fee is going to equal 450 multiplied by 12. Now, here's an important thing we need to take note of. This is very, very important because it can be different in different questions. So let me just go show you. So when they tell us about the 450, what was that now? Yeah. So they say Moya has decided to outsource its distribution. Okay, we know about that. They say for the delivery of prepaid airtime to its customers, Moya has proposed to pay Mashesha a fixed monthly fee of 450 and an additional 75 Rand per 100 kilometer travel. Here, this is very important. All amounts at today's value. Now, today is your current. It means year 0. We are working from year 1. So therefore, we need to apply the increase from year 1 onwards. In another question, they could say this information is from year 1. This amount is for the first year of the contract. Then that means we only apply the increase from year 2. So it's very important to identify whether the information, the numbers that are given, is the current numbers, meaning year 0, or is it for year 1? Because if it is for year 0 and there are escalation clauses, then we must apply the escalation from year 1 onwards. However, if the numbers given is for year 1, then you only apply the escalation clauses from year 2. Okay, so just very, very important. Don't make that mistake. So because this information is year 0, we need to apply the increase from year 1 onwards. Okay. So if this amount represented year 1, then the increase rate would only be from year 2. Okay, so very important. So 5.9%. Okay, and then therefore annual fixed fee year 1. So therefore it's going to be 5.95 multiplied by open bracket 1 plus the escalation clause. Okay, so that is the amount. So all I'm going to do, I'm going to plug that number in. I'm going to go to fixed fee annual, say equal workings. There we go. So all I'm going to do, I'm going to increase that amount. I'm going to say that multiplied by 1 plus that rate of 5.9. Okay, wait, I'll just plug it in 5.9%. Okay. And then I'm just going to drag it across. So what you can do, up to you, you can do every calculation in the working, or you can just do one. Okay, so I'm only going to do one because it's going to waste my time. Then you're going to say 5.9% increase per year. Because we already did show the one, how we got to working one. So now I'm just saying thereafter, we increasing it by 5.9%. Okay, so they understand this. You don't have to do the entire calculation if you're applying the same thinking. Okay, so that is the answer for that. Now we can do the variable. So for the variable, 75 Rand per kilometer, for 75 Rand per 100 kilometers. Okay, so I'm going to go back, working two. So working two, working two, what did I want to do now? So working two, it is price per kilometer. Okay. So increased for 5.9%, and then from year one. Okay, from year one. Okay, so that's what I'm going to do, what I'm telling them. And then I'm going to tell them number of kilometers per year. Okay, so that's all that we need. I just need to actually put in the years. In this case, we have to show per years, just easier that way. So years, year one, year two, year three, year four, year five. So if we go back to the scenario, we can see it is 75 Rand per 100 kilometers. So here they're telling us, based on the current information and taking into account Moya's growth plans, the following represents the kilometers of Mashesha expects its fleet of delivery trucks to travel over the next 5 years. Okay, so it is price per 100 kilometers. Okay, so we want not a number of kilometers, but a number of 100 kilometers per year. So here it is 75 Rand per 100 kilometers. So we're going to say that multiplied by 1 plus 5.9%. Remember, we're growing it from year one because the 75 Rand is the price of year zero. If the 75 Rand was the price of year one, then we grow from year two. Okay, so that's very important. Okay, so that's what we're going to do. And then we want the number of 100 kilometers. Okay, so all we're going to do is the price of 100, the number of 100 kilometers. So they gave us year one. So year one is 600. So year one, 600, 1, 2, 3. But we don't want the number of kilometers. We want the number of 100 kilometers. So I divide by 100. Okay, because the price is 75 Rand per 100 kilometer. If it was per kilometer, we left it as is. Then it was 60. Just make sure I'm taking the right number. 605,400 divided by 100. Then it was 612,665. 612,665 divided by 100, and then again 704,565, 704,565, 704,565 divided by 100, and then lastly it is 713,019, 713,019 divided by 100. Okay, so there we go. So therefore the fee would just be so now it will be that multiplied by the number of 100 kilometers. So there we go. Okay, so now I can go plug it in. So I'm going to say equal to that. Yeah, I'm going to say working 2. Okay. Now we go back to the scenario. Now go back to the top. So we dealt with that. Here they say we'll have to pay a once-off cancellation fee of 100,000 Rand in the event it terminates a contract before the expiration date. When it comes to financial management, when it comes to MAC, costing or financial management, you always need to make mention of all the numbers. Okay, so whether you're using it or not using it. So if you're not using it, you must tell them you are not using it. Okay, so cancellation fee. Cancellation fee, it's going to be 0. Okay, so we're going to say 0. We can just say only applicable in the event of cancellation. Okay, we don't expect to cancel. Okay, so so you tell them, so we just show it as 0. Okay, so remember, there's like I remember there was one question when I was a student that you would fail the question solely as a result of not including things that shouldn't be included. So for example, there were so many marks for explaining why you're not using something. If you did not do that, you wouldn't have passed the paper. You could have put in everything that you should have used correctly and get 100% for everything that should be included, and you could have gotten 100% for that part, but it would still not have been enough to pass that question, because a lot of the marks was as a result of you explaining why something is not included. And it's very important for costing, but it's equally important for financial management. Okay, so that number we made mention of, we're not including it because it is not relevant. Okay, so in order to undertake the delivery of Mashesha, we'll have to purchase a fleet of so here they say an upfront capital investment. Upfront meaning immediately. Immediately is now. Now is year 0, 4.8 million. So cost of investment, 4.8 million. Remember, it's an outflow, so we say negative 4.8 million. Okay, so we always gonna have tax loss. So I'm gonna do this quickly. Just do undo. Okay, so you're gonna have net cash flows. You're gonna have discount rate, which is WACC, and then we're going to have NPV. I'm just gonna do this. Okay, so let's continue. Okay, so we dealt cancellation fee, we dealt with cost of investment. Okay, so we dealt with that. Now they're telling us the vehicle requires 7 liters of fuel per 100 kilometers. So 7 liters of fuel per 100 kilometers for the first 3 years. Thereafter, it is going to be 9 liters per 100 kilometers. So we're going to set up the same way as we did this calculation. So all I'm going to do, copy out. Remember, you have to show your referencing, right? Because if we get something wrong, they're going to come to your workings. So just make sure to always include referencing. So working 3. Okay, so number of liters per 100 kilometers. Okay, so number of liters per 100 kilometers. So it is 7, 7, 7, 9, and 9. Okay, now we're going to go number of 100 kilometers. Okay, so we already calculated above. So we're going to say that. So even if you got it wrong over here, you must bring it through over here because they're going to mark you through. If you got it wrong over here and you bring in the right number over here, they're going to mark you wrong. Okay, so because you are not being consistent. So remember, it's not always about the right number, it's about how you are thinking and are you consistent. So if you got the wrong over here, just bring it in over here. So if you so let's say some people have calculated over here and calculated over here. So perhaps they got it wrong over here, but happened to get it right over here. They're not going to give you the marks because it shows that there's lack of understanding. Okay, so just make sure you are consistent per year. Okay, so this year is work. You don't have to put this here. I just usually do it. And then we're going to say cost per liter. Okay, so cost per liter. So now the cost per liter, we know it was there right at the bottom. So let's say the current price is 11 Rand 41 and is going to increase per liter based on those amounts. So 11 Rand 41 current price. So current price is here 0, 11 Rand 41. Then it's going to be that price plus 50%, 50 cents, so it is 0.5. Okay, then it's going to be that plus 70, 75, 80, 90, 70, 75, 80, 90. Then it's going to be plus 0.7. Then it's going to be that plus 0.75. Then it's going to be that plus 0.8. And then it's going to be that plus 0.9. Okay, so that's what they have. So therefore, fuel costs is going to be all of this. Okay, so it's 7 liters per 100 kilometers. There is 6,100 kilometers. So that will give us our total number of kilometers. And then we're going to have, then we're going to get the cost per liter. Okay, so 7 liters per 100 kilometers. There is so much number 100 kilometers. So that times this will give us the number of liters, the total number of liters, which is 6,000 or whatever it is. Okay, and then we're going to multiply by the cost per liter, which will give us the fuel cost. Okay, then we can go plug it in. Now remember, in my example, you never saw fuel costs, but it's basically falling under variable costs What is a variable cost? It changes relative to revenue. So it changes all the time. Fixed cost is fixed throughout. So you don't have to add the word variable and fixed. You just list the specific cost. So in this case, the specific cost is fuel cost. Okay. So it's going to equal, it's an outflow, which is a cost, so it's going to be negative that amount. So I'm going to tell them they can go have a look at working So I'll tell them they can go have a look at working 3. So working 3. Okay, so there we go. Next on the thing, so you see I'm going in the order of the scenario, so then I don't miss anything. Then, in accordance with the delivery fleet maintenance plan, annual maintenance costs expected to be 336 in year 1. Can you see in year 1? Not current, in year 1. So when do we apply the escalation? Only from year 2 onwards. Okay, so maintenance costs 336 in year 1. So now I'll go and I'll say maintenance costs. Maintenance costs. So in year 1, it's a cost, so it's an outflow, is 336, 1, 2, 3, and then I must grow it by 2% per annum. So it's going to be that multiplied by 1 plus 2%. Okay, so here I'll just say increased by 2% from year 2. There we go. That should be it. Let's see if I read it properly. Escalate will increase multiples of 2% every year. Okay, so it is fine. They say for accounting purposes, Bashir shall depreciate its truck over a useful life of 4 years. Okay, so you don't usually have to do this, but because they specifically mentioned it, I'm just going to show you. So I'm going to say depreciation 0, and I'm going to tell them non-cash flow. Okay, so I'm excluding it because it is non-cash flow. Okay. Then they talk about SARS allows for a straight line. We will deal with that in the tax calculation. Okay. They say the trucks will have a combined resale value of 1.2 at the end of 5 years. Okay, so that is that scrap value. That is that scrap value, realizable value. Okay, so you can call it resale value, doesn't matter. Resale value, that's what they used. So we call it resale value. A combined, it's not 1.2 per truck. It is total 1.2 million. So it's an inflow 1.2 million. Okay. The total monthly salaries of the truck drivers are expected to be 264 in the first year, with a 7% annual increase thereafter. So truck driver salaries, truck driver salaries. So remember the price, the cost is in year 1. They didn't give us the cost in year 0, the cost in year 1. So therefore, increase is applied from year 2 onwards. Okay, so increase is applied from year 2 onwards. What was the amount now? 264. So it's a cost. So we're going to say equal negative 264, 1, 2, 3. We only apply from year 2 onwards. So we're going to say equal that multiplied by 1 plus 7%. Okay, so there we go. Then they're saying there is other costs relating to the delivery fee is expected to amount to 65 in year 1. Once again, in year 1, 65,000. So other costs. So as an outflow, 65,000. And remember, it is they said other costs increased by the 5.9%. Okay, so this is 5.9%, which equal that multiplied by 1 plus 5.9%. Okay. So there we go with that. There we go with that. Other costs. Okay. So remember they said the fees paid to Moya and other costs relating to the delivery fleet. There we see other costs relating to the delivery fleet are subject to an annual escalation of 5.9. Okay, so 264. So we covered everything up until there. Under additional information, we took the fees into account. We must bring in the weighted average. We took the fuel into account. We took the kilometers into account. Okay, so there's nothing else other than tax. Now we can go work out tax. So now I can just delete this. Okay, so tax is going to be working for me, working for. So now go to tax, working for. So working for, same. Okay, the cost of the investment will come through as wear and tear. Okay, so the cost of the investment will come through as wear and tear. As they say, the SARS provides 20%. Okay, so what we will say, so wear and tear reduces taxable income. So we're going to say minus 4.8, 123, 123 multiplied by 20%. So the wear and tear is going to be based on 20% of the cost. Okay, so it's 960. 20% goes into 105 times over the 5 years. Just make sure that your costs do not exceed, your total wear and tear does not exceed the total cost. Okay, so it's 4.8. So the wear and tear, so let me just show you over here. The tax implication or cost of the investment would be wear and tear. There will be tax on this, there will be tax on that, there will be tax on that, there will be tax on that, there will be tax on that. There's generally tax on an opportunity cost, but there's no tax on working capital. Okay, so you don't, if you were given working capital, you don't bring working capital into your tax calculation. So using these stuff over here, all of this will have tax implications. So I'll just copy it over. And it will come through in the same direction. It will come through in the same direction. So we're going to say equal that amount. Okay. And just do that and bring it down. Okay. Just so you can take note of the following. Let me just show you something. So as you can see over here, the cost of the investment happened in year 0. Yet the wear and tear starts from year 1. Remember, the cost of the investment happens in year 0, which means the beginning of year 1. But SARS doesn't give you the deduction immediately. SARS, you only get the deduction when you submit your tax calculation at the end of year 1. So therefore, the tax comes through in year 1 because the implication of the tax only takes place at the end of the year. Okay, so just be aware of that. So just so now you want to know why is the cost in year 0, but we start the tax in year 1, because remember year 0 represents the beginning of year 1. Now we don't get the deduction immediately, we only get the deduction at the end of the year. So therefore we put the first wear and tear takes place year 1. Okay, so just take note of that. What's happening over here? Can I drag it? 5.9. Oh, sorry, you didn't drag it. Okay. Okay, so there we go. So now this will give us, this answer will give us not tax. It doesn't give us the tax. It gives us taxable income. Okay, very important. This number gives us taxable income. we're not interested in taxable income. We're interested in tax. But to get tax, you need to calculate taxable income. Okay. So therefore, from a SARS point of view, we are making a profit. From a SARS point of view, we are making a profit. So therefore, the tax at the tax rate at 28% is, all we do, we change the sign. We say that negative of that number times 28%. Okay, so therefore, this, we're going to pay 113,000. It makes sense that we expect to pay because we're making a tax profit. Taxable income represents a tax profit. That means we have to pay SARS tax. So it's going to be an outflow. If taxable income was negative, it means we made a loss. Then we're not going to be paying SARS, then this amount will be positive. That's why you just change the sign when you work it out. Okay, so now when I go to the tax here, I just say equal to working for. So now I would have, some okay, so there we go. So these are all the future cash flows. Okay, so I need to make a point quickly. So the way the calculation is set out over here is how you do it if you're writing. Okay, if you're doing it physically, writing it on paper. If you're using Excel or Google Sheets, then we'll just do a slight adjustment. Okay, so the slight adjustment would be as follows, because this is how the calculation in Excel works. So I'm going to highlight this in orange only because it's only applicable when it comes to Excel or to Google Sheets. But if you are writing it in, if you're writing it down, you will have it how it was set up before I inserted this orange lines. Okay, so here we will have present value and we will have cost. The discount rate is WACC. The discount rate was given to us as 15%. Okay, so the discount rate was given to us as 15%. So these orange lines are inserted. It is only because of how Excel and Google Sheets operate with the calculation. So remember, if you have a look over here, I don't have that orange lines. It simply comes to NPV, because when you write it out, the way the financial calculator works is slightly different in terms of how Google and Excel work. So let me just show you. So I'm going to work out I want NPV. So I'm going to say equal NPV. Okay, so I'll open up a bracket. I'm going to press over here. So here you can see NPV. Then they first want the discount rate. Then they want cash flow 1, cash flow 2. Okay, so they first want the discount rate. Then they start from cash flow 1, right? So the present value is 14 million. Now, in a financial calculator, when you use your financial calculator, they start with year 0, not with year 1. Excel and Google Sheets starts with year 1. They don't take into account year 0. So the answer that Excel and Google Sheets give you is the present value. So therefore, I need to go fetch the cost. So now the NPV would be the sum of present value minus cost. So we'll get NPV of 9.8. If you use your financial calculator, in your financial calculator, you will start off with year 0. So therefore, the amount that the financial calculator brings you is not the present value, but it is the NPV. And that is why when you set it up using a, if you're going to write it out and use your financial calculator, you simply have it like this. But if you're going to use Excel or Google Sheets, you will have the two extra orange lines. Just so you understand, NPV equals cost, equals present value minus cost. Okay, so that's just basically what's happening over there. So as you can see, the NPV is positive. So we will say NPV greater than 0. Therefore, Mashesha should accept. Okay, so therefore, Mashesha should accept. Okay, so that's basically it. Do you have any questions if you want to ask? So that's basically the answer to this question.
What I wanted to ask, it wasn't in the question, the working capital. Like I'm not sure how it comes into this NPV calculation. Like I understand what working capital is, but I don't like in a project, I don't understand how it would come in like in reality.
Okay.
What it actually means in a calculation like this.
Okay. So for example, ShopRite want to open up a new store. ShopRite want to open up a new store, or Woolworths or Trueworths, whatever. In order for them to make sales, they're going to need the inventory. So inventory forms part of working capital. So in order for them to open up the store, if they're not going to have inventory, there's going to be no point in people coming to the store. So therefore, they're going to need working capital up front in order to run the business. Does that make sense? So in year 0, which is the beginning of year 1, they will have working capital coming in because they have to incur the cost of obtaining working capital, the inventory, to actually start making sales. Does that answer your question?
Yes, so like here, since we have that cost of investment of 4.8 million,
Yeah.
so in another case, it would be working capital instead.
No. It can all be both.
Is it?
Yes. So for example, what I wanted to say now, I wanted to say, I just think of another.
So like the working so the cost of investment here, it was, if I remember correctly, the cost of purchasing the
vehicles. Yeah.
The vehicles,
Yes.
right?
So for example, like this is not the best, I guess, but I just maybe bring it closer to our minds. Maybe not the best explanation example, but if you open up a new store, they're going to need furniture and fittings, right? So for example, the shelving, they're going to need the till operating stuff, the fridges, and all of those type of things. So the fridges, the shelving, the till, the whole, you know, the whole till thing where the groceries go on, the computer and stuff. Those would be, because that is assets that will be used over a period of time, and you're going to depreciate it. So that is a long-term asset. So that should be your cost of investment. So all of that, they'll probably add together. That's the cost of investment. Then the working capital would be the groceries in the store. And so that is basically how to come into the scenario.
Okay. Yeah, I get it. Thank you.
Okay. You can see here is, if the question asks for I or R, So for IRR, in your using a financial calculator, if you use an HP calculator, you'd have say second function clear all. Okay, so that means now there's no memory on that calculator, and you don't want it to be memory. Then you will go and you'll plug in 4.8, and you'll press the plus minus button, and you will say cash flow. Then it will give you it will pop up cash flow 0. Then you plug in 3890 and you press cash flow, pop up cash flow 1. Then you press in 4111, the full number, cash flow 2 will pop up. So you'll do it up until cash flow 5. Then you'll say 15, and you'll press the I button, the I button, and then you will say second function NPV. Then it'll give you this number. Then automatically you'll press again second function, and there's a button called IRR, and you press IRR, and then it'll give you IRR. That's how you do it on a financial calculator. On Excel, I must do the full number. I must do the full calc. So on Excel, if I needed to do IRR or Google Sheets, I will say equal IRR. So the Excel have IRR, open up brackets. What do they want? They want me to put in you can see they want the cash flow amounts, and then they want me to plug in a guess. So the cash flow amounts, I think they want it from year 0. I'm not 100% certain. Why is it not working? Okay. I'm not 100% certain. I think they want it from year 0. Okay. And so whenever in Excel and in Google Sheets, whenever you have to work out a percentage, a rate, then you must put in a guess. So you can see it'll say rate guess, they put in 1%. Okay, so you make up any percentage. It's only a guess. They just want you to put in a guess, so that for whatever reason. Okay, so they just use that they have 1%. Okay, so they're saying the IRR is 82%. 82% is greater than 15%. So therefore, you accept. So IRR greater than WACC. Therefore, accept. So as you can see, they're both giving you the same decision. They're both saying to accept. So that's basically it. Okay, any other questions? Any other questions? Who's here? Dane, Bongani, Nonku, Talita, Sinclair.
I'm all good, thanks. I just wanted to know, for those question papers that you sent us, the exam question papers, do you have solutions for them?
No. So I never did the solutions, and I don't think you need to share the solutions. That is why most people actually ended up doing the question bank. But a lot of those question papers, I have recordings. So the recordings you will see under the first semester, and yeah, under the first semester, a lot of them I've worked. A lot of those questions I have used that as the example in the recording. That is why if you what now? If you work through that, so I want to have the one-on-one session, because I understand that there's no point in doing a question and you don't know the answer. So that is where the one-on-one thing comes in. So you work through, then I can guide you and see this where you're going wrong and so forth.
Okay, cool. Thanks. I'll check the
Okay.
site out.
Any other questions? Now the questions. So this is working capital. I'm going to, not working capital, is capital budgeting. So the next lesson will be Thursday, and then we will do valuations. I will do a free cash flow valuation, and I'm probably going to do the same question I did with the other guys with semester 1, because it covered free cash flow as well as PE, and that's important that you cover both. And then I just briefly explain how to do dividend growth, because dividend growth is basically the same like free cash flow. There's only some significant differences in terms of which numbers you use, but the setup is exactly the same. Okay, so the format is exactly the same, but the numbers that you include is significantly different. And I'll just explain to you. For free cash flow, you use these numbers. For dividends, you use that numbers. So I only do free cash flow and PE, because ultimately dividends is going to be the same in thought process. If there's no other questions, then we guys are good to go.
Thank you.
Thanks.
Thanks, bye.
Pleasure. Bye-bye.
Thank you.
Pleasure. Bye-bye.